every link in the chain needs to step up, and there'll be probably lags and other things within the chain which will cause bottlenecks at time. But overall, I think it's a concerted approach, right through from the mine, through the fundings, through the people who shed light on the pricing and the the stockpiles and all those sort of things that are normally hidden from view.
I think governments around the world and regions around the world have recognised the importance for some form of intervention to try and stimulate the development of critical mineral projects and production capacity.
What looks like a bankable project in critical minerals in the absence of these commodity features of a price and the ability to hedge the price, and it really is, which is my focus on bankable offtake agreements that trigger that.
It is good to see governments around the world are starting to realise that they need to work together with industry to back these projects.
I'd like to bring to the stage Julian Babarski, Chief Investment Officer at Jigsaw Investments, Jan Fuchter, Director and Project and Structured Finance at Export Finance Australia. You can sit anywhere. James Kruger, Partner at New Electric Partners, and Dan Porter, Portfolio Manager for Resources at Pure Asset Management. All right, because it's a nice, intimate crowd, we're going to keep it quite conversational. We do need the mics to capture it on the video. But yeah, if you have any questions for our panelists throughout, just put your hand up and we will address them as we go. Definitely nicer to keep it a bit more conversational. We don't need to keep anything too formal. Maybe to kick things off, a quick introduction about who each of you are and what you're focused on. So Jan, if you want to kick us off, it should be on.
Hi, Jan Fuchter from Export Finance Australia. My focus at EFA, as we know in short, is on the mining sector. Most recently, very much focused on critical mineral projects in support of the government's critical mineral strategy. So hence looking at critical mineral projects in Australia that also include downstream processing and also in terms of diversifying the supply chain, which sounds very short and simple term, but it can be quite complex. But more broadly, EFA has been involved in mining finance for a long time across the world. So we have a sort of range of experience in terms of commodities and jurisdictions.
Okay, James Kruger, New Electric Partners. I'd had a 20-year career in Macquarie in Hong Kong and connectivity to Korea and Japan. Macquarie, a commodities bank, but also looking around the corner of where trends are, and one of those was mobility. And in the capacity of being at Macquarie and holding assets like Grab and Didi, I just saw very early on the sheer scale of electrification of transport and knew that was this supply chain, and these types of discussions were a thing. So I've set up a consulting business that is really the customer-led aspect, so connecting the battery OEMs to developing mines and stringing that part of the financing stack into critical mineral projects.
And hello, I'm Julian Babarzi from Jigsaw Investments. Jigsaw is my own investment company, and until a few years ago, I was a key member of a hedge fund based in Sydney called Regal, where I worked for 15 years, mostly across investing in mining and resources. So I was very involved in the funding of a lot of the critical minerals projects that are listed, that were funded over probably the past decade. And now I'm getting more hands-on in investments that I'm choosing to do myself. So I'm on the board of a couple of listed companies. I've come off the board of one more recently that was in the lithium space called Ioneer. It's got a nice project in Nevada. And I'm making some investments into other critical minerals projects, but more earlier stage ones where I can take a hands-on approach and help them grow and access capital markets to hopefully prosper. So very active in the equity side of smaller growth companies.
Hi everybody, my name's Dan Porter. I run the resources fund for Pure Asset Management. We launched that fund about 18 months ago. I had about 17 years on the sell side as an equities analyst prior to that. was with UBS and Nomura prior to setting up at Pure. We're a little bit different in that we're a hybrid debt fund, a dedicated hybrid debt fund, and we specifically provide financing for mining projects that are in development phase, almost a pre-project finance or a pre-production facility. Plugging the gap, I guess, that's left by equity markets that sometimes misprice some of these assets. And we've had a really good run and certainly a lot of support in the market for what we're doing.
All right, great. Thanks for those introductions. So global decarbonization is a major theme for the commodity space right now. And one of the, discussions that we've been having over and over in this room is that there's not enough metals, not enough supply of metals and critical minerals to fill the looming supply gap. So what's the supply demand outlook for the critical minerals at the moment that you are seeing? Whoever wants to, Dan's looking at me. You can kick it off.
Thanks, Amy. I'll kick off. Yeah. Yeah, no, absolutely. I think it's fair to say that across most commodities at the moment, we're seeing a huge supply and demand gap. If you look at LME inventories, they're at all-time lows, despite the fact that we have ever-increasing demand for new and old world commodities, if you like. Certainly with what governments have put in place in terms of policy development over the next 5 or 10 years, there is a huge demand for commodities involved in electrification. But I guess for critical minerals in particular, these are by their very nature critical to supply chains, but often overlooked. And they're overlooked because they're often used in smaller quantities than traditional, copper or things like that. But they're often, ancillary resources as well. They might be on a side of a copper mine or something like that, or involved in fairly remote regions. They're often processed in developing nations as well, given the costs of processing a lot of these minerals is very high. It's very challenging to do that in most sort of first world nations. So there's a big push to bring those back home, if you like. Around the world. So there is a huge and growing demand for these critical minerals. In terms of the financing for that, I think that's one of the reasons that they've, that supply and demand gap is so large. I think for traditional financiers, it's hard for them to get their heads around. There's not a lot of offtake. You can't hedge things out. There's not liquid markets to sort of invest in these projects. The major banks don't understand them necessarily. They're quite removed from a mortgage, but they're also quite removed from other types of mining as well. So it's very challenging. There's less and less, I think, dedicated mining funds out there in the world too, which means that access to capital is hard, not just expensive, but it's hard to actually raise the capital there, which will probably mean that we'll have issues over the next 2 to 3 years and longer potentially. But it is good to see governments around the world are starting to realise that they need to work together with industry to back these projects.
Yeah, look, I just might add to that I think, just touching on a few of the comments, these are often very small markets, as was said, and I think the delta in the amount that's required to be produced over the next decade is just enormous relative to the current market for some of these. So I think the supply response is actually going to be quite difficult and challenging in many respects. So if you're looking at supply and demand, I don't think it's as easy in many of the cases to just apply the typical LME mindset for some of these critical minerals, which aren't traded on the LME, so they're difficult to predict. Often the production process is more cumbersome and problematic. Often the specifications are much tighter as well, so you've got to get purity levels that a lot of mining operators aren't used to. They're more chemical process, particularly for lithium and other sorts of outputs. So I think that in many respects the sell side at times oversimplifies, I think, the supply response. They put it in their model, they assume all the projects are going to work on time and on budget. And I think doing that in mining and resources at any time is difficult because everything takes longer and costs more. But I think particularly in some of these critical minerals where the specification requirement and to be able to produce these commodities at the right specifications consistently at high volume is much, much harder to achieve. So the one everyone's talking about at the moment is the lithium market, because clearly the lithium stocks have run exceptionally far. Many of them are being priced as producers, even though they're not. And so, you'd argue there's a lot of risk in some of those companies that are still yet to deliver the project. But you've got some big investment banks calling for a pretty imminent oversupply because their models tell them that all these things are going to come on time and on budget. I just don't think that's the case. And a lot of these critical minerals are much trickier to bring on stream. So I think that's making funding sometimes more difficult as well, because equity markets tend to be the high risk end of the market. And as was said, you can't hedge these commodities in many respects. So the funding parties have to either be people in the industry, offtake partners, or it's got to be equity markets. And if equity markets get a note from a very large investment bank saying that the supply is going to be more than satisfied, it backs investors off and it pushes equity prices down and makes it difficult for companies might have big capital requirements to fund that without diluting their share base too much. So I think it's a classic situation where I think on paper it looks like they're going to be well supplied, but I think in reality we're going to find that there's going to be lots of volatility in the underlying commodity prices, but it's probably going to have an upward bias, which should generally support the funding. But I think until there's more mines up and running in some of these critical minerals projects, it's still going to be a very small and unique set of investors who are prepared to take the risk.
Well, smart guy. Only just to add to that, the customers that I talk to, the battery makers and some of the car companies, their pennies dropped around what Julian's talking about, and particularly with lithium. Hasn't got and nickel, Inflation Reduction Act requirements around nickel will create more demand for Western supply chains, and lithium is clear that we've seen all that activity from the battery and car makers. They're capital constrained as well. Like they've got a lot of gigafactories to roll out, so they don't have endless money supply, and just picking another mineral, graphite is currently not a focus for them, but a prediction for that is that will become like lithium this year. The penny will drop on having Western supply chains for it as well. So to summarise what Julian's saying, supply is overstated and demand is the demand crunch is acutely felt by the end customers.
I agree with all those comments made prior to this. I think it can also be quite nuanced. I think we all agree that, for instance, lithium, a huge demand, but there is a huge amount of lithium around the world, and I think where the nuanced aspects comes to it is really there's a huge concentration of the downstream processing, for instance, lithium hydroxide plants. Which tend to be concentrated in one particular region of the world, and we've seen now various companies trying to develop those in other countries, and until that sort of capacity becomes available, I think we're going to be facing those kind of constraints in terms of supply. The government has announced a list of 26 critical minerals. They're not all equal, certainly in terms of strategic drivers and also the supply and demand equations. For instance, rare earths again. Those who are geologists tell me that despite the fact they're called rare, but they're not rare at all. But there are a number of projects in Australia that are hoping to come to market to produce a rare earth oxide, which is great in terms of Australian industry and the mining sector. But again, the pinch point is in the downstream processing to convert from a rare earth oxide to a rare earth alloy or metal. Again, those production facilities are concentrated in one particular region. So I think it's sort of there needs to be a lot of development across the board, not only in terms of supply of a concentrate or ore, but also that downstream processing capacity.
Okay. And so, Jan, you mentioned that you're working with the government about these new funding structures to fund critical minerals projects. What role do you see for governments, investors, corporates, everyone in the industry? How do they all interact to kind of get get the financing for critical minerals projects?
I think the challenge with many critical minerals is that the appetite from the private sector, depending on the critical mineral, can be limited. And that really sort of, as Julian mentioned, if you look at the participants in the financing of these projects, it tends to be equity or offtake finance. The days of banks having the luxury of only financing minerals that have a terminal market, LME, base metals or precious metals. I think the whole development of the mining sector and mining finance, that's all changing quite a bit. Given the importance from a strategic and geostrategic and supply chain constraints, I think governments around the world and regions around the world have recognized the importance for some form of intervention to try and stimulate the development of critical mineral projects and production capacity. And if we see the various initiatives around the world that have been announced by various governments or groupings like the European Union, I can talk more confidently about the Australian government's critical mineral strategy. That was focused very much on providing supply, not only of sort of a concentrate or a beneficiated critical mineral, but also taking it further downstream. We now see other countries around the world trying to follow a similar kind of path. All the key partners of Australia, Canada, US, various countries in Europe, Japan, Korea. So I think there is an awakening around the world to deal with the energy transition, to deal with the development of electric vehicles, energy storage systems. So I think as this rolls out, hopefully it'll give the private sector increased confidence in the viability of these projects. Quite a bit's been spoken about lithium. And using lithium as an example, I think there's an increasing degree of comfort amongst the more traditional mining finance sources. And I think you'll find an increasing amount of private sector support for the development of lithium projects. Other commodity or critical minerals, are more challenging to finance, and I can talk to rare earths. We've been through the exercise of financing a rare earth refinery, some of the more, if I can call them, exotic critical minerals. I think those will continue to be quite challenging from a financing perspective.
I think.
Well, you go. I'll go, Dan.
That's right. I think awareness of the use of critical minerals is going to be a big issue going forward. I think people are now aware of where we use lithium, and there's a lot of interest in that from outside the resources sector, which is driving finance towards development. I think you probably need a big communication strategy from the industry. You could say that about a lot of projects, but I think for critical minerals in particular, we use them every day. We just don't realise where we use them, and I think that's an issue for raising money more generally. But I think the sector's got a lot of work to do, and government needs to work alongside that as well to make sure that everyone is aware. Different levels of government have had different strategies. I think the New South Wales government is doing a very good job at the moment of making, or creating awareness outside just the resources industry. I think that needs to keep happening. But if people were aware of where they used tungsten every day, it would be much easier to finance a tungsten project. So it's a little bit about the industry just boosting themselves up a bit as well.
Yeah, I think lithium's benefited from Elon Musk talking about it, I think, and people becoming aware that it goes into a pretty nice looking vehicle that drives really fast, and I think that's tangible for the man in the street to understand. Whereas you're right, tungsten and other critical minerals, people wouldn't have any concept of what it's used for and how much our lives benefit from it. So it's raising that visibility. And I think the other thing that needs to happen and is happening is understanding the price discovery for some of these commodities as well. They're very they're bilaterally negotiated, so there's no transparent pricing mechanisms for investors to get their head around a business model and an economic case, the cost is normally pretty easy. The capex is relatively easy, even though they're normally too low than where they end up being. But the revenue line's the most crucial part of it, and that becomes very difficult for investors to get their head around. So people like Benchmark and Fast Markets in lithium and graphite and other things, I think they're crucial parts of the chain that have come a long way in the last 5 years, particularly because no one, I was one of the early investors into Syra Resources, and working out what a ton of graphite sold for was near on impossible without the help of these guys, even though I must admit the prices I was talking about was much higher than what the reality was once they came into production. But that's symptomatic, I think, of the risk with these commodities. It is very difficult to work out what a ton of this stuff sells for, and it's quite nuanced because a ton of what one mine sells might be a different specification to what another mine or process sells for. So it's difficult for investors in that context to get a lot of conviction, and maybe that's where government and other areas can step in. The government uses a blunt instrument a lot where they hand out funding to companies, and you've seen a bunch of critical mineral companies around Australia receive very significant amounts of funding, and that's very helpful, and it raises the profile with listed investors. But it doesn't necessarily guarantee success either. And so, it will be very nuanced, and I think it generally then starts with the industry. It needs to be industry players who step up and help some of these operations get up and running. And the car companies was a good example for lithium. The fact is they need the lithium. They've all made huge, multi-$10 billion investments into gigafactories and new production lines. If they can't get the raw materials for the batteries, then they're going to have a lot of ghost towns there that won't really be able to produce cars that move. So they're getting off their backsides and actually, backing companies. And I think that's pretty important. So I think it's really every link in the chain needs to step up, and there'll be probably lags and other things within the chain which will cause bottlenecks at time. But overall, I think it's a concerted approach. Right through from the mine, through the fundings, through the people who shed light on the pricing and the the stockpiles and all those sort of things that are normally hidden from view.
So there's a link in the chain. There needs to be a concerted effort, and that is nuanced by mineral really and by location. But there needs to be a lot of coordination around the different contributors to finance. I'll just leave a thought around this topic, which is if the national debate started talking about critical materials as opposed to just critical minerals, we'd go some way to understanding where these products are and where they end up and what the value chain is, and potentially a little bit more understanding of Australia's role in the downstream processes of them and the financing of them. So I'd like our national debate and our coordination, which is required, to start thinking about it as materials rather than minerals. But that's just a thought bubble. So I'll leave it there.
So what types of projects are you seeing getting funding right now? Beyond lithium, which seems to be the hot topic of the day, what else is moving in the industry?
Well, I think from an equity point of view, anything that goes into a battery has got a lot more visibility and interest than a commodity that doesn't. And that's just because, again, it's visible and people understand Tesla's doing a great job and for want of a better word, they're sexy at the moment in terms of commodities. So people want to buy things that are topical. So I think they're probably the easiest ones, and it's the ones that are more hidden, that are more problematic, that don't have that mind share. So that's, I think, the way I'd summarise it is that anything that relates to battery, and that's not the full breadth of critical minerals, but they're the easiest ones to probably finance at the moment.
Yeah, what I'm seeing is a lot of projects that are where you've got serious supply concentrations in countries that may not be top tier allies anymore. So moving out of places, China, Russia, South America, where there is very much a country risk to that supply chain, is a big issue for a lot of investors at the moment, but a lot of end users. And so they're pushing, for critical minerals projects and other projects alike to be manufactured in, sort of Western countries and countries where there's allied relationships. That 10 years ago we didn't think about that, but in the last 18 months that has become a huge issue for a lot of these projects. So we see a lot of the industry where you might have a concentration of 80-90% of that entire global supply coming from one country, and that is creating a real headache for end users, and where they where they've made huge investments, as Julian was saying. These companies are making tens of billions of dollars worth of investment. They need to know that they can get that material easily and quickly, and it's not going to change in 2 years' time.
We have a question from the audience.
Can I just continue on from what Dan was saying there, and maybe ask Jan and is it James? You can give companies and projects money to get up and running. Sometimes you see these projects were in production decades ago in a different era. We're probably going into a new era now of trying to have dual markets. And that's the definition, right, of critical minerals. So you can give them money, but how much work is being done on developing, say, a different price index for like a critical price index or a Western price versus, you see the difference now in the Russia versus Western markets for oil. Is there much work being done on price guarantees or developing different price indexes depending on the channel that it's come through?
That in the way I would translate that question, it's a clear question, but just the way I would frame that is what would satisfy the debt financiers of a project in critical minerals, and it really is the offtake and the bankability of that, and they all need to have floors in them, and they all need to be offtake of a certain credit rating, and then. So that's one part of it, and the other part is the political risk insurance when you're in, African jurisdictions, etc., is somewhat ameliorated by having the local banks involved, the sovereign banks, and then also to Jan's expertise around the export finance agencies, and the coordination of those. So, if I'm translating part of your question right, it's really what looks like a bankable project in critical minerals in the absence of these commodity features of a price and the ability to hedge the price, and it really is, which is my focus on bankable offtake agreements that trigger that. But Jan, perhaps you want to elaborate or expand on that in terms of the export finance coordination and linked finance, etc. Korean and Japanese and Australian agencies and the like.
Yeah, sure. And I think that the question that you asked is you touching on one of the key risks of financing critical mineral projects, because quite frankly, for a lot of commodities, there is no price index, and so that touched on the point that Julian made earlier, that there's the absence of price discovery mechanisms. So tying that in with James's point, to try and get comfort on the revenue line of a project, you have to look at the offtakes and the degree to which you can derive comfort from the terms of those offtake agreements. And so any discussion that we have with a critical mineral proponent, one of the fundamental requirements we have is for them to try and mitigate the risk associated with the revenue line by ensuring as robust as possible offtake agreement with the buyers of those particular products. Now, one of the challenges we have, certainly in Australia, is that given that most of the critical mineral proponents tend to be junior companies, and so when they go off and take James with them to negotiate with some of the buyers, say in Korea or Japan, they are negotiating with these massive companies, and you just have this massive power imbalance. So there are so many different dynamics involved in these kind of issues, and ultimately, that is one of the reasons why agencies such as ours, Export Finance Australia, our international counterparts across the world, are becoming involved in the financing of these projects, because ultimately, given who we are, given essentially our shareholder is the government. We may have a sort of different risk appetite or a different view on risk than the private sector would. have that would enable us to provide that funding. That doesn't mean that it's just a blank check to every proponent that may have a critical mineral project, but these are the kind of initiatives together with government, together with the private sector, that we try and provide that sort of incentive for these projects to become financed. And what we also try and do is work with banks who do have appetite for some of these projects, because we think it's a good discipline to have lenders from different backgrounds or different shareholders, so that we still try and instill the commercial discipline that's required for these kind of financing.
You brought up the idea of risk with the investments. How do you assess this?
Yeah. Where do we start? It's a long list. Yeah.
Half an hour.
Look, it's without wanting to get into detail about how we assess these risks, I think it's important to try and identify what those risks are to start off with.
Mm-hmm.
So, we've spoken about the market risk in terms of the revenue line, and that involves who the offtake counterparties are, or the buyers, what the terms are. But then we also have some of the other key risks is that very often with critical mineral projects, the proponents propose to use a processing technology or flow sheet that is unproven at commercial scale, or there's a novel aspect to it. So straight away that introduces a different technical risk than would normally be involved, say, with a base metal project. Then you have proponents who tend to be of a junior nature. And so how do we mitigate that technical risk? Well, we typically, as a lender, we would like to have a robust degree of completion support. With a large mining company, they would provide a corporate or a guarantee that the project would be completed on time and within budget. Given that these proponents tend to be junior companies, that isn't possible. So, we try and look for mechanisms how to deal with that. And then you have junior proponents who just don't have the necessary capacity and capability to manage all aspects of a project. And so you have a number of risks or residual risks that as a financing party, be it equity, be it debt, would need to have appetite for those kind of risks. And that's not to say that lenders or investors can't get comfortable with that, but it just depends on what the risk appetite is.
Perhaps a good cheat sheet proxy for all of those risks that Jan's talking about is capex over market cap. So these projects, when their capex is an order of magnitude over what their capacity to raise money, it's a significant hurdle, a significant amount of risk, whether that is geological, market-based, flow sheet-based, etc. And you just have to pass that out and support and concerted effort as part of the management of that risk. But they're extremely hard, or they're extremely obvious what the risk is if you just look at the capex of the project over market cap. That's an extremely nuanced method of trying to manage that, and one of it is getting the debt financing stack worked out very early in advance, how that's going to be combined and what the offtake is going to look like. So, for example, if you just had a trading house with a marketing agreement, that's not going to cut a project. So you really need to pick and build the risk management techniques around your financing stack and who's going to contribute to the risk management of it.
Just following on from that, I think the market cap for some of these companies is often very low because they're very illiquid and they've got such a small audience. The investor universe for a lot of critical minerals is still very small. And from an equity investor's point of view, it's harder to put a bigger amount of money to work if it's a highly illiquid company, which doesn't give you the opportunity, if you're wrong or change your view or need to redeploy funds to exit some of the positions. So that whole liquidity risk within the stock market for some of these companies is a huge hurdle to get over as well for a lot of financiers. So I think you're right. If you've got a a funding stack that needs to be solved for, the more you can do ahead of time to minimise the equity portion of that, the easier it can be, and the more likelihood the stock is to trade much better to allow that equity piece to be done. Because until you solve any of that stack, then I think the market assumes it's all equity. And for a company with a 50 million market cap but a $500 million capex requirement, it's just too lopsided. And then companies get into the spiral of having to sell project level equity, which is very valid, but that often comes with hooks and the like, and it can be very difficult for companies to solve through that. And again, the universe of equity investors for some of these things is really, really small. They're not covered aggressively. These companies aren't covered by the larger investment banks. They're covered by really small niche stockbrokers, and they have a limited audience. The funds that they work with have much smaller balance sheets, so smaller amounts to deploy. So there's levels of risk all the way through the chain, unfortunately. I think I just keep coming back to the fact that the audience for some of these investments is very limited. So finding the big checkbooks in an industry is probably key for some of these companies to get funded also.
And I'll just add one final comment, but oftentimes in critical minerals, you'll find heavy concentration of end users. So you might have a situation where you have one mine supplying one customer. That makes it very difficult to attract financing. That is changing as markets change and as the use of some of these critical minerals changes as well. You're getting much more diversification in the end customer. But for a lot of these minerals too, it is still very, very concentrated industries. So it's a level of risk that a copper market, for example, just doesn't have, which again is just it requires visibility. And to Julian's point, you need more eyes looking at those stocks.
But just to maybe put a positive spin on this as well, as an investor, that often presents opportunities as well, because in an unloved sector with a limited audience, you often get mispricings, and it's normally mispriced the wrong way, which is that these things are too cheap. Yeah. And so if you can introduce the capital or part of the capital, help the company get introduced to people who can unlock either the funding or the offtake, you can actually create a lot of valuation upside. So I guess that's part of what I'm doing is I like to fish in areas where there's not many investors, because that typically is where you see opportunity. If there's lots of investors pricing things like lithium, things get frothy. And I'm not saying the whole sector is frothy by any stretch, but I think there's pockets of overvaluation in that sector. And I think where there's no real interest, that's areas where you can get bargains as an investor. But you've got to be more patient. You've got to have capital that can be deployed over years, not months. And so it often takes a more hands-on approach as well to work with these companies to educate them as to how to solve some of these things. So all these risks we talk about from an investor's point of view are very valid, but they can also create huge opportunities for people to prepare to cross that Rubicon and take that risk.
Yeah, I'll second that. I mean, with what we do with Pure, with our hybrid credit, we're getting a lot of inbound from the industry. We've done a few investments in that space, and as that becomes more well known, those peers and industry, contact us. So we're in discussion with a number of these projects at the moment. It does take time, and the nature of what we do, we can be a bit more patient. So it suits those companies as well. But we're happy to jump in where for us with Pure, we're happy to jump in where the banks and things just don't want to go yet. But yeah, hopefully we can make some good returns in the meantime. Yeah.
Do we have any questions from the audience before we continue on?
I think I read that the US is maybe due to revise their critical minerals strategy next year, or revise the list. Is there any inside word or particular areas of thinking that where they might change things to potentially influence the market? And I'm also thinking of particular areas where they've maybe destocked critical mineral stockpiles in past decades where they might need to reverse that trend.
We've heard read some of the commentary. I think whether a mineral is on the critical minerals list or not doesn't really, in my view, doesn't really drive sort of any response from investors. I think really what drives the response from investors is ultimately the demand. I think whether or not a mineral is on any particular list produced by a government in terms of critical minerals, I think that really the consequence of that is that it would just make it eligible or more easily eligible for support from the respective financing agencies that may exist in that particular country. But from our perspective, we support both critical mineral projects as well as non-critical mineral projects. So we tend to be agnostic, but certainly we do focus on critical minerals because it's leaning into the government's critical mineral strategy. Sorry, if I can just add one more thing. For instance, I know there has been some debate on whether nickel should be on the Australian list of critical minerals. I think from recollection, it is on the US.
It is.
Yeah. So it's interesting debate.
And I was going to make that point that nickel's on the US list, but not on our list. Then I was going to dream forward and say a critical material would be mixed hydroxide precipitate, but that's me dreaming forward. But to your point around the US movement, I think the Inflation Reduction Act recently passed with the tax credits for battery materials that are either extracted or processed in a friendly jurisdiction is a significant game changer for the whole industry, and there is significant amount of movement that's happening as a result of that. And I think that's the most significant thing we'll see versus variations of lists. I'm not sure of stockpiling strategies. I know that they're, the DOE and the Department of Defence are coordinating a lot of effort around giving of grants to like midstream processing, etc., and then also trying to step into supply chain financing for African minerals. So they're already very active in unlocking some of these risk-based roadblocks that we're talking about.
It's amazing, isn't it, that there is a list of projects out there to the government is saying, hey, look, we're about to run out of this stuff. I can't think of another industry anywhere really, not just in mining, but where you would actually have the government saying, hey, look over here. It's amazing that it doesn't stimulate more demand on both sides, both for the projects and from financiers. I think that will change over time, but it is fairly unique that we have this out there, and it's not driving more interest. Yeah.
Just following on from James's point about the Inflation Reduction Act, what sort of impacts have you seen so far, or maybe what sort of impacts do you expect to see in the industry coming out of this?
Well, I think there was the Korean president was visiting Biden, and his mic was still on, and he was overheard swearing about Biden in Korean and made big headlines in Korea. But that just shows you how significant the Inflation Reduction Act is for a lot of Korean OEMs, Hyundais, etc., that have a lot of capital in China around their midstream process, and they know that that's got to have to move. And so it's a significant driver of strategy on sourcing of supply and financing of new projects.
We have a question from the audience.
Speaking of midstream processing, critical minerals and risk, wholesale power prices have quadrupled in Australia over the last 12 months. Is that a concern for onshoring processing away from that certain region we've been talking about to the north?
Probably not the most qualified, but it is a huge risk, I think. Although I think given the consternation around all supply chains being in places like China where there's a lot of opacity and the ability to stop supplying parts of the world, I think that a lot of countries and a lot of end users have to make the decision, do they just pay more for certainty? And I think we're at that point in the cycle where people have to make those tougher decisions. And if anything, that just supports the investment case for a lot of these commodities because it pushes the cost curve up. There's structurally higher power prices, and whether that's transient or it's sticky, that remains to be seen. But the reality is, I think the old days of just pushing everything to the lowest cost jurisdiction and shutting your eyes both to, labour, the way the labour's handled or the environmental concerns, I think those are generally past. And a lot of the OEMs, for example, have been forced by their consumers to have audits through the supply chain for all sorts of things, including now, energy prices. People want clean energy as part of the manufacturing process. So I hope that people who make these sort of statements around wanting to have certainty on some of the clean supply angles and everything actually follow through. It's different when you go into recessions. In boom times, everyone's happy to pay the extra because there's a lot more money sloshing around. If we go into a recession, then I think a lot of the promises and the goodwill tends to fall away for economic reality. So it remains to be seen. But I do think it's a real risk. Although it's fair to say energy is going up everywhere, other than maybe China, because they can control that a bit more than everyone else, can't they?
To give two case studies of possible, positivity on that question, which I agree with, and Julian's response. But just you look at West Musgrave Oz Minerals project in Central Australia, but Western Australia. They've got a once in a lifetime generational 40-year life of mine asset that can support renewable energy zone and the financing of that. So the mine's so big and the capital flow to the mine that the power purchase agreement for a renewable energy construct can be financed separately. And so you will see large mines supporting renewable energy projects that are separately financed. That's one potential case study. The second, I'd refer to QPM's Queensland Pacific Metals Townsville Tech project, where you've got a combination of a future renewable energy zone with great infrastructure, but also new technology in the midstream that actually solves for. It's just a better mousetrap if it works, and that's a big if. Going back to the risk question, but if it works, it's a better mousetrap. It's got better yield, and so there's a technology answer to that as well as a renewable energy zone type footprint answer that goes some way to responding to that question. And to put the patriotic hat on, we're very good at midstream process. We've got very good engineers in this country. So stepping from extraction and a mining product into an engineering product to get these midstream products, these intermediaries before they go to batteries, is well within our capability. Shipping costs as well, and the reduction of those, there's some economic sense in that. So, lithium hydroxide, we ship out, as an example, and to Jan's earlier point, we ship out spodumene, which is 94% waste on very expensive shipping lines into China. And that's a 94% waste product. There's an enormous amount of fuel saving if we produce locally, and if you can do that in scale, that supports renewable energy zone construct around that refining. Then the costs become competitive. So there is hope.
All right, we have probably time just for one more question.
Sorry over here. Just on that point on renewables, what's your view on green or ESG premium? I know it's a bit controversial.
So if you asked me that question a year ago, I would have said there's no green premium. I've heard from some of the Korean OEMs with respect to nickel, for example, that they would be willing to pay for a green premium. I think the Inflation Reduction Act almost necessitates it. So that's another part of the previous question is that the ESG aspect of the material does have a profile, and then some of any extra cost could be absorbed, but it's not. Yeah, no one's going to pay double for a greener product, but a 10-15% maybe.
I think it depends on the product too.
Of course.
Yeah. In a lot of cases, depends what you're doing, where you can get it from. But in order to attract capital to a mining project now, you need to have those policies in place. You're just not going to get finance without it anymore. And I think that will feed its way through the system. so there will be a premium, whether we implicit or explicit. It remains to be seen, but I think it will be there in the sector regardless.
All right, we do have a few more minutes. If there's any other questions from the audience before we wrap oh, we've got one more over there.
I was going to ask Julian and Dan what their top 5 stock picks are, but I'll do that, I'll do that afterwards.
I don't think we can go on record.
I know it is not quite financing questions, but there's been increasing automation in a lot of manufacturing. This will help with the labor shortages. How are the financier taking this into account at all?
So part of that question could be new processes, so new midstream processes that haven't been proven in scale. You know, financiers need to be comfortable about that, and that requires demonstration plants and scaling up responsibly. In terms of labour costs and the inputs into the project financial model, I'm not seeing a lot of assumptions that those labour costs are going down, and or the headcount is going down in current financial.
Well, because like the robot technology is coming along quite well in Europe and US in particular. So I just wondered, especially with the labour shortages, then if they can be trained to do whatever is necessary in each different industry or factory or wherever, so that can make it much more efficient in some way and probably cost effective.
Yeah, I think that definitely applies for the end stage, the battery type product, and obviously cars and the like. But correct me if I'm wrong, I'm not really seeing much.
Well, I think in terms of primary production with the larger mines and larger mining companies, you know, I think it's well known that companies like Fortescue, Rio Tinto, BHP have very large scale automation initiatives on their iron ore mines, which, based on my very uninformed reading, does appear to be quite successful. The extent to which that drives down their costs, I can't really comment, but certainly I think one potential issue it does address is perhaps less of a reliance on fly-in, fly-out workers. So I think that has a social dimension to it. But I would imagine that those kind of mining companies wouldn't invest in these kind of initiatives if they didn't pay for themselves.
Okay, well, that actually brings us to the end of the hour. I'd like to thank all of our panelists for joining us today, Julian, Jan, Dan, and James. Thank you.
Thanks, Amy.